Hello, judges. My name is Alexander Lee.
And my name is Chris Singla.
Today, we present an in-depth analysis of Pagaya Technologies, a trailblazer in the financial technology sector.
Based in New York City, Pagaya Technologies serves a global market, specializing in financial technology, particularly AI-driven lending solutions. With $1.8 trillion in applications evaluated as of now, Pagaya is able to employ AI-powered underwriting accurately and quickly. The company operates under a business-to-business-to-consumer approach, aiming to serve the approximately 42% of U.S. consumers who are denied credit under legacy models. Pagaya collaborates with 29 banks, also called lending partners, and is backed by 105 funding partners. Their service spans various verticals, including personal loans, auto loans, point-of-sale financing, credit cards, and single-family rental properties. The business fee revenue is fee-driven, derived from fees amounted from lending partners and investors, thus relying on the ABS industry for revenue.
Nextly, let's go over our service demonstration. When a borrower submits an application, the lender system evaluates it. If the application falls out of the lender's credit criteria, it is automatically forwarded to Pagaya's AI model for evaluation. PGY's AI then produces a recommendation for the lender. Upon receiving the recommendation for Pagaya, the lender extends a loan directly to the borrower. The funded loan is offloaded into Pagaya's network, where PGY sells it as an asset-backed security to investors. Moving on to our stock overview. In recent market activity, the stock of Pagaya has experienced a decrease in value, currently priced at $10.06 per share, with a market capitalization of $628.23 million. Despite this recent downturn, the company has reported robust financial figures, with revenue reaching $812 million and EBITDA standing at $82 million.
The asset-backed security industry is integral to fixed income investments, comprising diverse financial instruments derived from pooled assets like loans or receivables. Issuers bundle these assets to create securities which are then bought by investors. The ABS market has witnessed a significant growth, a result of improving credit conditions following the pandemic. This is shown by the chart with significant increases within January and February of 2024. We decided to segment the ABS industry into two key groups: financial institutions who deal with a wide array of financial services, and AI fintechs like Pagaya and Upstart, who focus on utilizing their AI to underwrite high-yielding loans. In this comparison, we assess Pagaya and Upstart, direct competitors in AI-driven lending.
Pagaya has multiple advantages over Upstart. Firstly, Pagaya demonstrates resilience in fluctuating markets, evidenced by a 49% year-over-year revenue increase in quarter 3 2022, while Upstart experienced a 34% year-over-year decrease during the same period due to its susceptibility and suboptimal credit environments. Upstart still remains trapped from these environments with 4 consecutive quarters of revenue decreases from previous years. Concerning the balance sheet, Upstart faces constraints due to its funding model, being reliant on its own capital for loan origination, whereas Pagaya's pre-funded model allows for a lighter balance sheet. Finally, Upstart's personal loan credit evaluation AIs is on the 15th iteration, with its nearest iteration being underwhelming, according to analysts cited by American Banker. Conversely, Pagaya consistently produces high-quality ABS yields. KRB assigns Pagaya's Class A note product level 20% over Upstart because of their advantages in subordination of junior class, note classes, and maintaining an inclining cash reserve account, effectively reducing defaults.
Let's look at Pagaya's income statement. First, there's an impressive year-over-year revenue surge of approximately 8.4%, signaling Pagaya's notable expansion of its network and outreach. Furthermore, decreases in product development, customer acquisition costs, and administrative costs indicate commendable maturity of the company. Despite these improvements, Pagaya's net income, however, is still remains at negative $128.4 million.
In 2023, Pagaya became significantly less liquid, with a decrease of approximately 40% in cash. This was due to Pagaya investing large amounts of cash and expanding their network. However, considering Pagaya's pre-funded model, this raises concerns about liquidity, given Pagaya's dependence on readily available funds. We view this as a necessary risk Pagaya must take to expand their business. We believe Pagaya will be able to minimize this risk, however. This conclusion is based on Pagaya's recent appointment of permanent CFO and a closing of a deal involving BlackRock that provided Pagaya with a large credit facility.
Further examining Pagaya's income statement, we observe expenses such as product development, sales, marketing, and general and administrative costs, all of which are either stagnant or declining. The primary scaling expense for Pagaya is production costs. constituting approximately 63% of total revenue. Given that Pagaya's main expense aligns with revenue, increasing overall revenue is expected to enhance operating gross margins effectively. Additionally, Pagaya has taken clear steps to reduce non-scaling expenses, including a significant decrease in share-based compensation by approximately 71%, a result of an increase in vesting periods. For our evaluation, we conducted a standard scenario analysis DCF for Pagaya, comprising a base case and a bear case. The base case saw an upside potential of 205.9%, and the bear case saw an upside potential of 40%. At a value of $10.06, we view Pagaya as being very undervalued. Through the scenario analysis, we see great upside potential within both the base and worst case. Furthermore, we chose to do a relative valuation on Upstart and Pagaya to compare the two's valuation. Using a relative valuation of EV over EBITDA, we see that Pagaya is trading at 11.6 times EBITDA, while Upstart is trading at 15.6 times EBITDA, showing again that Pagaya is undervalued.
Moving on to our investment summary, we evaluate Pagaya as a buy with plans of holding from 5 to 10 years with a target price of 22.5. This conclusion is derived from the following theses. Firstly, there's large growth runways. Pagaya's total addressable market encompasses various lending verticals, with the company already dominating the personal loan sector and expansion efforts into auto loans and point-of-sale financing, facilitated by strategic partnerships with entities like Auto Captive and Westlake, indicating significant growth potential. With plans to penetrate a majority of its serviceable addressable market within 5 years, Pagaya is poised for substantial growth. Pagaya also stands to benefit from favorable macroeconomic conditions, particularly anticipated rate cuts by the Federal Reserve in 2024. Amidst robust labor market and consistent loan demand, Pagaya's business model is well aligned to capitalize on these tailwinds, enhancing investor confidence in the ABS industry. Finally, Pagaya's revenue trajectory will be bolstered by increasing adaptation among lending partners. With rising AI implementation rates and ongoing negotiation with top banks, Pagaya is strategically positioned to drive revenue growth through both expansion efforts and fee adjustments with banking partners.
Let's look at some investment risks. The issuance of a new stock by Pagaya resulted in an 18% depreciation and a 13% share dilution, leading to a crash in share value. However, the offering is expected to yield $109 million in gross proceeds for Pagaya. We project these funds to sustain Pagaya through the end of 2024. Furthermore, as Pagaya enhances its margins and strives for profitability, the necessity for future stock issuance diminishes. Another risk is defaults. Pagaya recognizes the volatility in retention investments, with potential fluctuations impacting revenue and stock value. Their mitigation efforts include lowering conversion rates and net retained percent.
Moving on to ESG, firstly, Pagaya's operations have a minimal direct environmental impact, given their business nature and modest infrastructure. This aspect reflects Pagaya's conflict-free approach to environmental considerations. Regarding their social aspect, Pagaya's AI-based loan origination prioritizes expanding access to loans that don't fit traditional credit evaluation systems. Thirdly, examining governance, Pagaya is run by Gab Krubininer, a co-founder and CEO. He brings extensive experience in investments and wealth management, particularly in innovative credit structured products. In response to concerns about the Israeli conflict, he has opted to relocate headquarters to New York City. Pagaya has also relocated its technology infrastructure, including data and cloud platforms in the US, providing further reassurance amidst potential conflicts.
Let's look at how AI development will affect Pagaya. AI technology is emerging as a potent force of innovation within banking, reflecting its potential to enhance efficiency, drive growth, and manage risks effectively. While this may enable banks to develop in-house models, Pagaya's access to diverse lending partner data gives it a competitive edge. Facing challenges such as reduced earnings and tightened loan standards, banks turn to AI for solutions. Pagaya's AI enables microsegmentation of customers, expanding access to financial products. Given the challenges in accessing financial products and the ongoing advancement of AI, we foresee an escalation in AI reliance among loan offering financial institutions. Thus, AI adoption isn't just desirable, it's indispensable for survival.